Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are higher here on an upbeat payrolls report in hopes that the conflict with Iran could end sooner rather than later. Let's look at what this market uncertainty does mean for your portfolio. Management geopolitical tensions are putting cold water on the global rotation play. Michael Sayers joins me now. He is portfolio manager at Rockland Trust. Michael, it is great to see you. So maybe just start there with that bigger picture, Michael. You know, Iran, oil, geopolitics front and center, of course. What is the message, Michael, you think the market is sending us about all that?
Well, it's different today than it was yesterday. Obviously, the market was pretty worked out yesterday about higher oil prices. But I think when President Trump came out and made some announcements around all the things the U.S. Can do to essentially continue to have oil flow through the Strait of Hormuz, that really settled down investors. And so you're seeing a rebound today, lower oil prices and higher stocks.
Do you think, Michael, the Fed is looking through the kind of volatility we're seeing in the oil market right now?
No, I don't think so. I think the Fed ultimately does pay close attention to commodities markets, particularly oil. And so I don't think they'll look through it, so to speak. I think they're more likely to be, a bit more hesitant at their upcoming meeting in terms of if they were considering a cut. They'll probably be a bit more cautious at the next meeting.
I guess if I'm an investor, Michael, I'm still trying to figure out what this all could mean for corporate profits. I've had a couple strategists, investors tell me, listen, just too soon to say. Do you agree with that?
Yeah, probably too soon to say, more broadly. I mean, obviously for the energy companies, high oil prices directly feeds through to higher profits for those companies. But I think when you step back and look at the rest of the industries and sectors in the S&P 500, it's an additional headwind for, say, the consumer sector, consumer staples, and consumer discretionary. But I still think looking forward this year in 2026, there's more tailwinds for the consumer than headwinds. So if you think about potentially lower interest rates, probably not in the first half of the year because of the higher oil prices like we just discussed, but maybe in the second half. You think about things like business and tax refunds that are, hitting now and are going to continue to hit accounts through April tax season. And then finally, this deregulation wave that the administration is also pursuing. I think all those tailwinds are going to, more than outweigh any headwinds that are coming from, higher oil prices.
In terms of the labor market, Michael, ADP slightly above consensus there. Big jobs report on deck. What do you expect to hear there, Michael? And how important is that report for the market?
Yeah, the jobs report is always very important. I think for a while now we've kind of settled into this dynamic where there's not a lot of hiring going on in the labor market, but there's also not a lot of firings either. So it's sort of this steady equilibrium, albeit one with not a ton of job growth, but enough job growth to kind of just keep the economy, moving forward and continuing to grow.
In terms of the stock market, you think cyclicals I see here they retake leadership. How come, Michael?
Right. So just to step back for a second, I think what you've seen over the past few months is a rotation away from the AI theme and the tech trade, and investors have kind of been looking to other areas in anticipation of a reacceleration of the U.S. economy this year. And so, the conflict in Iran has put a little bit of a pause on that cyclical trade, and more recently, investors have thrown a bit over to the defensives. But ultimately, because of all the tailwinds that I discussed earlier, I do think that cyclical leadership returns. So sectors like consumer discretionary and financials.
What about those mega cap AI names, Michael? What are your thoughts there? What do you tell clients?
Well, they've done great for a number of years in terms of earnings growth. But you look at the staggering numbers that they're spending on CapEx now that we're through earnings season. You tally it all up and you're looking at over $600 billion of CapEx spending for the hyperscalers, so to speak, this year. And essentially what all the big tech companies are doing is spending almost all of their operating cash flow and putting it back into the business. So that makes investors, a little bit uneasy in terms of, is there going to be a stop to all the spending, and ultimately, are there going to be strong returns at the end of all this. So I think that's why investors are kind of taking a break from those names and looking at some of the other sectors, cyclical sectors.
Let's get to some specific picks there. You like Lululemon. That name, of course, has been just shelled. So what are the catalysts ahead, Michael, that you see that say, okay, this one's going to move higher?
Absolutely. So there's a few of them. First off, they're going to be announcing a new CEO pretty soon. I think that could be a positive catalyst. I think investors are looking for a proven operator there. The prior CEO, was running the business, but was also the creative director, and that just didn't work. So they've split the role. They have a new creative director who's really focusing on new product innovation, refreshing the assortment, and also moving into other categories like athleisure, also menswear as well. So we think that if the North American business can stabilize and the international business continues to grow 20% plus with higher margins than North America, then the earnings profile is likely bottomed here. And you can get very strong returns over the next few years as we see earnings growth, but also multiple expansion for Lululemon.
And finally, Michael, Amazon. I've had a couple of smart tech analysts come on, say they like this pick. It sounds like you do too. You say the most attractive it's ever been actually on a sum of the parts basis. Walk me through that.
Yeah, that's right, Josh. So what we see going forward is on the retail side of the business, since really the pandemic, Amazon has embarked on this massive build out of their network infrastructure, the fulfillment centers, the logistics, et cetera, et cetera. And so they're kind of coming to the end of a 5-year build there. So going forward, we think the incremental margins on additional sales on the retail side will, the margins there will inflect higher. But the bigger driver is Amazon Web Services, AWS. In the most recent quarter, we saw growth reaccelerate there as well into the 20% plus range, and that's a higher margin business too. So the one caveat I would have is if this huge CapEx spending continues beyond 2026, then maybe you won't see as much margin expansion as we currently expect. But if this is the peak for CapEx for them in 2026, then we expect pretty big incremental margins and very strong earnings growth over the next several years.
Michael, thanks for your time and those picks. Appreciate it.
Thanks, Josh.
Let's look at how other areas of the market are moving, starting with Bitcoin rallying back above 73,000. Yahoo Finance Inez Murray and Jay Conley are at the desk with me. Inez, let's start with you and walk us through what is going on with crypto.
Yes, look, we are seeing resilience in the Bitcoin market as strategists are putting it, but it's more than resilience, it's really relative strength. When you take a look at the last couple of days with Bitcoin and today's surge, there's strategists that are saying this isn't just a short squeeze. You've been seeing ETF inflows, 860 million over the last 2 days. Compare that to the volatility that you saw in the market. Also, some strategists calling this a geopolitical crisis hedge, even perhaps an inflation hedge, because if we're talking about higher oil prices, then we're talking about inflation as well. You also have President Trump that put out a post last night talking about the Clarity Act that he's really pushing.
What was he saying there, Inez?
He's basically saying that the banks need to get it together, that they have to negotiate for this Clarity Act. Otherwise, it's basically giving a little bit more of credence to, okay, maybe he's not so much for the banks in this case because of the yield issue with the stable coins.
Which has gotten so heated between the banks and Armstrong. Right.
So this would be positive for crypto. And then you have Kraken and Kraken Financial. This is the digital asset arm of the crypto exchange Kraken. They now have a master account. They have access to a master account at the Fed. This is the first digital asset bank to have access to this payment system that normally is used by traditional banks. So this is huge for everything that has to do with this narrative of it's not just that crypto is an investable asset, it's now it's being integrated with traditional finance, and everything is going to eventually move to blockchain. That's what the next 10 years are really about for the crypto space.
I know you keep a close eye on sort of Wall Street forecasts and what they see ahead for Bitcoin. Any new forecasts out there?
There's not new forecasts yet as far as, I mean, they've already downgraded their forecasts. You've got FundStrat's Sean Farrell that is predicting 115,000 by the end of the year. You have some forecasts that are 100, 150,000. But what strategists are saying is most likely that what they've been watching is, okay, we are in this downtrend. We're seeing this rally right now in this downtrend, but there may be a leg lower, and then you'll see a bottoming in the summertime, and then you'll see crypto rallying to the end of the year. That's what a lot of strategists are saying, but you could already have seen a bottom. Who knows? I mean, the fact is that there is this downtrend that's been happening. This is very much relief for crypto enthusiasts and investors because they're seeing that compared to the rest of the market, what the volatility that we've seen. I mean, it was at 63,000 on Saturday morning, and now it's at 73,000. That's a huge move.
Yeah.
The other thing I'd add here, Josh, same time as crypto's going back up, you see volatility coming back down. 2 days ago, the VIX was at 25, this really key stress level. Now it's down back near 20. That is a marked decrease in how risky the market is seeing all this. And so people are saying, maybe I can get back into Bitcoin. Maybe this is the time to get back into a more risky asset like crypto, especially as Ines points out, when it's becoming a bit of a geopolitical hedge, which we really hadn't seen with it before.
Switching gears, Jake. So that's crypto. What about oil, front and center? What are you seeing there?
Oil is calming down, right? You saw last night President Trump saying that the U.S. would provide insurance and security guarantees if needed in this
Basically
strait.
a naval escort.
Exactly.
Yeah, right.
You might see some of these tankers coming through here with a naval warship right next to them, which is big for the market, but at the same time, some insurance folks I talked to tell me no one's going to want to be a first mover there, right? Because if you're going through there with a U.S. naval warship, is the risk that you're going to draw the attention and the ire of the IRGC. Now, where is this headed? Are we at the top? Are we at the bottom of oil? Obviously, if we see another big shock, strategists who I talk to tell me you could see Brent at 100, Brent at 90. But the much more consensus picture is that Brent's probably going to trade 80 to 85. Maybe it'll come down a bit, probably around there. There is
any
still
new
that.
forecasts out today, Jake?
Yeah, so you saw Goldman actually
What did they take it to?
bumping up their Q2 predictions to the low 80s actually, which is a market step up from where they were. They were down in the 60s and 70s.
Although, would you consider, Jake, I mean, low 80s, I mean, in context, would you say that's a real headline grabbing number? I mean, it's not like 100.
No, it's not 100. It's still a risk premium of maybe 10 to 15 bucks over the fair value, but it's not 100. It's not a fear level that people are going to be screaming about.
Yeah.
And that's the thing also with this U.S. Navy and the insurance is that it's calmed the market, but the risk premium isn't gone yet. And that's what strategists are saying. You really need to see this executed to see how is this going to work? What will these companies that are shipping these tankers say, yes, okay, yeah, we'll send them with an escort and the insurance. I mean, there are people's lives that are obviously at stake that they're watching as well. And even one CEO saying, what if a tanker does get exploded, and then what happens environmentally? I mean, there's a lot to consider here.
Jake, to Inez's point, I was hearing a lot of skeptics about this today because they were saying, I mean, it sounded great when you got that post. You hear, hey, Navy escort, insurance backup.
Great in principle.
Right, but then you heard skeptics say, well, hold on, like really making this work to really get flows moving strongly again through there, that seems like a challenge.
Yeah, it could be a couple of weeks before you really see movement from people in the insurance industry that I talk to. Again, nobody wants to be a first mover, but at the same time, they need clarity. These insurance policies the U.S. is talking about, well, what happens if a tanker gets hit? What happens if someone dies? What happens if you lose that oil? You look at the major insurance clubs, they've got setups for all that. Now that the U.S. is going to try to step in, okay, it's good to see that the administration's thinking about it, but what are they actually going to do? Surprisingly, the U.S. market doing okay today, right? The S&P up around 1%, the Dow up 0.6%. But where you're going to really keep seeing this stress is Asia. You turn over there, Nikkei closing down 3.6% at the close today. The Kospi down 12%, biggest loss on record because they're so exposed to this.
Yeah.
They get so much of their oil from the Middle East. And so now you see these Middle Eastern nations and these Asian nation leaders coming in to step in to try to tell the administration, look, we need resolution. We need to get a fix to this. We need to see some forward progress. I think the administration's insurance and protection market push is part of that, but I think the market's going to need to see more before this calms down.
Let me ask you this though, Jake. I can understand why some countries say that, but I do wonder whether the Trump administration is looking at China and saying, we just delivered basically like a 1-2 punch to Xi. I mean, I just rocked both his Venezuelan and now his Iranian flows. That hurts. And that's leverage. I wonder how they might think through that.
Yeah, I think that's right. It is leverage.
Yeah.
Pretty much all of Iran's barrels, since the sanctions were put in place, were going to China. Obviously, China was a big buyer of Venezuela. The interesting thing here, what I'm hearing from people I talk to, this could actually push China toward Russia. Because Russia needs somewhere to offload its oil. Moscow is desperate for revenue. China needs barrels. Those independent refineries along the Chinese eastern coast are a little more risk on. So maybe they start turning toward Russia. And so is this, a bit of a boon for Moscow, a boon for Putin, but it is going to hurt China, absolutely.
But it may be a knockoff effect because really what the administration is also paying attention to is what's happening here, because you have gasoline prices that are going up. Those are accelerating. You're watching the national average of gasoline in 2 days went up by 20 cents. Okay, yes, it's not like it was in 2022, but still, this is a rapid change of pace for the average American that goes to fill the pump. And then you've got diesel that's also accelerating even more because diesel is more of a global has more of a global market to it. So there's consequences to oil prices going higher. I mean, this is why
it's a good point, Jake. Inez brings up. It was only last week I would have economists come on, and if you push them like, hey, what are tailwinds for the American consumer, they would immediately go last week to 30-year fixed is sub 6, right? And the national average for your gas was like sub 3. Right?
Yeah, exactly. And the thing to remember here, gasoline prices go up much, much faster than they come down. Because these companies that are selling this gas are going to price in the risk, and then they're going to be much slower to let off that valve, bring prices down naturally. As Inez points out, the diesel market is really hot right now. Jet fuel prices are soaring. Wholesale gasoline soaring. All of that's going to come through to the pump for the American consumer. And this isn't, as Inez was saying, this isn't measured in weeks, this is measured in days. Prices are going up right now, but it could be weeks before they start to come back down, before that American consumer starts to see some of that relief.
All right, Jake and Inez, thank you so much. Great chat, appreciate it. Meanwhile, big tech chiefs are at the White House to sign a pledge to protect Americans against higher electricity bills. This comes alongside big tech's rising demand for power to meet the needs of expanding AI data centers, and Jennifer Schonberger has been following this. Jen, what's the latest?
Hey there, Josh. That's right. Executives from major tech companies gathering at the White House right now to sign a pledge to ensure that Americans' electric bills don't increase as a result of building out data centers to support artificial intelligence. Google, Microsoft, Oracle, OpenAI, Amazon, and xAI all signing what is being dubbed the Ratepayer Protection Pledge, ratepayer for electricity rates. Now, under this agreement, companies are pledging to build, bring, or buy new generation capacity for data centers and cover the full cost of infrastructure upgrades needed to service their data centers. Where possible, these companies will add capacity to serve the public by increasing power supply. Companies will also negotiate new separate rate structures with utilities and states wherever they build their data centers, and they will pay these rates for power and related infrastructure that are brought online to service their data centers, whether they use that electricity or not. Now, Energy Secretary Chris Wright saying that the administration is ultimately looking to cap electricity prices so that electricity prices ultimately decline, this part of that effort to do so. Josh?
So Jen, just so I make sure, so is this sort of like a voluntary pledge, Jen? Like, is it sort of like handshakes all around? Or no, we should really think of this. This is like, new legally binding policy.
So it's a little bit of both, Josh. It is a voluntary pledge, but where the rubber meets the road is that these companies are investing and negotiating major power purchase agreements, and these are long-term contracts, generally about 15 years in length, that are going to be signed with states and utilities. So if these companies are signing the dotted line, that they have to adhere to those agreements for years. And so this is a major change for states like Texas that are going to be seeing these data centers built out. And as I mentioned in my reporting, they are expected to pay new rates that they are going to negotiate with states and with power utilities.
Let's say, Jen, despite these moves, right, our utility bills, they keep climbing. I'm curious who you think politically would get nailed by that. Who would get the blame? Is that Trump? Is it big tech? Is it both? What do you think?
It could be a little bit of both. I mean, ultimately, the administration is touting this, so probably the buck stops with the president, with Energy Secretary Chris Wright. We'll have to see how this plays out, though. And to your point, you know, we hear a lot about rising electricity prices, part of that being AI, but it's not just AI, right? There's a lot of demand across this grid. So there is a lot of other actions that this administration needs to take to bring electricity prices down. This is just part of it.
All right, thank you, Jen. Appreciate it.
Yeah.
Coming up, the private credit market seems to be flashing warning signs. We speak to an investor about the health of that market. That's next on Market Domination. Flashing warning signs growing for the private credit space. BlackRock's flagship private credit fund revealing signs of jitters in the industry as investors withdraw a record 7.9% in the past quarter. To talk through the stress beneath the surface, we have JP Morgan Asset Management Global Alternatives Strategist. That would be Aaron Mulvihill. Aaron, it is always good to see you. Maybe let's start here, Aaron, because private credit getting a lot of attention for good reason. But maybe in plain English, for those watching at home, start here. And when we talk about private credit, define that for us. What do we mean?
Great to be here, Josh.
Yeah.
Private credit is nothing different to regular lending. So think of it as lending, and whether it's lending within the fixed income markets, bond markets, a downside focus is really important when evaluating these investments. But it's not a new category of investment. It's been around for a very long time, but it has grown very significantly.
Why has it grown so fast, Aaron?
So what we saw, if we go back kind of 15, 20 years, go back to the financial crisis time, 2007, we saw a lot of regulation on banks that forced banks to pull back from certain types of lending. And of course, capitalism abhors a vacuum. We saw a lot of companies step into this space and offer solutions to companies in terms of lending for buying companies, for real estate, all types of lending across the economy.
And when you look at this space down here, and this is interesting, you do say there are yellow lights flashing. Okay, what are those lights, Aaron? Where are you seeing the stress?
I'd say yellow warning lights, not red warning lights. Not a sign to avoid private credit at this point, but certainly a sign to be selective. Manager selection is always incredibly important in any kind of lending, as well as asset selection. So this is something that we look at in our Guide to Alternatives that comes out every quarter, and we just put out our last quarter's guide very recently. So when we look at private credit, some of the things that we're looking at are where is it invested in terms of sectors? Recently, we've heard a lot about software, concerns on the equity markets relating to software. And when we look at private credit markets, there's quite a lot of investment in tech and software. Now, that's not necessarily a bad thing. Investors can make up their own mind if they want to be allocated to one sector or another, but it's important to have an understanding of where these investments are allocated and choose wisely.
How does the AI theme play into this, what we're talking about?
So in the last couple of years, we've started to see AI companies fund their expansion through debt. Still fairly small scale in aggregate. Most AI companies, as we know, are very cash generative. They're making revenues, they're making cash, and they don't need debt. But we're starting to see them tap the debt markets, both on the public side and on the private side.
Could viewers listening to this right now, Aaron, is it possible they own private credit and they don't even know what could it be in their retirement portfolios or, I don't know, insurance products?
Very early days in terms of using private credit in retirement products and other areas. It's not an asset class that's sort of broadly available today, but it's growing very rapidly.
You see, and to be clear, Aaron, this is a yellow light. It's not like you are looking around and the data suggests to you, yikes, 2008. Here we go again with some type of, the subprime mortgage crisis. You don't see that. This looks contained to you.
Very far from that. I speak to my colleagues across the bank very often about this. We ask, is it a systemic risk in private credit? Absolutely not. It's certainly a time to be selective in private credit and choose investments very carefully. But there is a premium of private credit. So if we look at why do investors invest in private credit, that makes a lot of sense. We have interest rates coming down. It's harder and harder to generate income right now from a traditional 60-40 debt equity portfolio. And so investors are turning to other sources of income. Private credit has been a very helpful source of income because it offers a premium relative to traditional fixed income, relative to high yield, there's a premium. But it's just important to be selective when choosing a manager to access private credit.
Well, that's what I want to ask you, Aaron. Let's say, okay, I want exposure to private credit. As an investor, what are the key questions I need to be asking?
There are a number of questions I think to ask. One, look at the manager's history, their capability in private credit. Have they been managing private credit portfolios in a broad spectrum of the economy? And it's important also to be able to deal with private credit and investments in good times as well as bad times. So the longevity of an asset manager is very important in this regard also.
Switching gears, final question, Aaron. On AI data centers, I thought this was interesting too. You're telling clients investing directly in data centers does carry risks. So what are those risks, Aaron? Walk me through those. And then if those are the risks, are there smarter, in your opinion, ways to play that theme?
There's a lot of ways to access the AI theme. Investing directly in data centers is certainly one way, but I think there's some underappreciated risks. One is obsolescence risk. I've spent a lot of time in my previous career building data centers. I've been in a lot of data centers. A data center today is very different from a data center 10 years ago because they're custom built to house the GPUs. They have cooling systems, electrical systems. We don't know what a data center 10 years from now is going to look like. So there's a technological and obsolescence risk there. One of the ways that we see as a safer way to play that theme is investing in the power generation infrastructure behind that. Because whoever wins in the AI race, whichever model wins, whichever types of data centers win, they're all going to need more power, more electricity.
And when you talk about power generation, break that down simply, Aaron. What are we talking about?
Yeah, so this is the electricity providers that are generating the power through renewables, through solar, through gas, all these sources of power. They're providing power to consumers as well as businesses. And now data centers are new demand for that power.
Aaron, always so great to see you, especially on set. Thank you.
Great to see you, Josh. Thank you very much.
Coming up, we bring you some of today's top trending tickers on Yahoo Finance. Time to see today's trending tickers. Yahoo Finance's Brooke DePalma joins for a look at Ford, some Starbucks, maybe a little Abercrombie. We'll see. We'll get started here with Ford. Automaker reporting a sales decline in February in the U.S., Brooke. As you know, we watch Ford very closely in the Lipton household. Big Ford family, got two in the driveway here's what happened. They post lower U.S. sales in February. EV sales, now they slide around 70%. Hybrids, they fall by around 20%. Now your go-to traditional internal combustion cars, they tick down by about 0.1%. But that EV business, yikes, the federal tax credit for EVs, of course, ends, and that has been an issue.
Yeah, and Josh, you and I have also discussed that a Ford Bronco is my dream car. So Ford, if you're listening, let me know how you guys can make it happen.
Jim Farley, make it happen.
But right now, the Ford stock, though, it is actually up 1%. And this might be because of a note that we did get from Bank of America, said that Ford toughs it out in the right profit pools. They reinstated their buy rating on the stock with a $17 price target. They said that they think Ford is well positioned to capitalize on the significant shift in the regulatory backdrop under the current administration that should enable it to shift focus to its most margin accretive trucks and SUVs. They also expect it to benefit from its leadership that it has right now in pickups. That F-150 does incredibly well for them. They're known for it.
That's their bread and butter.
And so that is sort of, going to continue to be its bread and butter, it seems like.
Moving on, Starbucks, the coffee giant, seemingly planned to open a new corporate office. Where, Brooke?
Nashville.
That's right. And why not?
Cue the music.
One of the great cities in the country. Unbelievable. So this is the Journal saying, yes, Starbucks plan its flag in Nashville, new corporate office there. They say the timeline expects to open the office later this year. They do plan to offer positions to, they say, dozens of existing folks in Seattle to relocate. The company does say Seattle will remain the North American and global headquarters, but who doesn't want to relocate to Nashville?
I know, I was kind of wondering myself. I mean, unless you have family, you have ties to the Seattle area, could be a little hard.
Nashville's
doesn't sound like for Josh. Sounds like he's ready to pick up and go.
I should be in Tennessee. It makes sense.
But sources at Starbucks did confirm to me that this is happening, and this really comes at a time where Starbucks is trying to keep its leadership, maintain that hold that it has on the coffee market share within this coffee industry here in the U.S. It really looks to grow not only in North America, but also it wants to grow in the Southeast, Northeast, and really that central U.S. region, especially because it has such a stakehold in the upper Northwest. And so this is sort of a strategic move ongoing from there. Also think about how it really wants to expand globally, sort of Tennessee being that middle area in which it could do that to create sort of a better opportunity to work with their sourcers, their refiners, the companies that
also
get the
just
beans.
Nashville. You had to be at Nashville. All right. Finally, retailer Abercrombie & Fitch under pressure as its first quarter outlook falls short of estimates. So this one expect sales growth to slow this year, Brooke. They're forecasting sales decline, looks like between 3 and 5% in 26, and that would be a slowdown from the roughly 6% increase in sales that they logged last year. Though it was, the Journal saying it basically in line with the gain the Wall Street had penciled in.
Yeah, and I was actually pretty surprised when I went to go look up the coverage of this stock. There's only about 13 analysts who cover Abercrombie & Fitch. Right now they have 8 buys and 5 holds, no sells on the street. Also, year to date, the stock has been underperforming significantly, down about 24%.
Yikes. Yeah.
And also, too, one bright spot that the company just can't stop talking about is Hollister. Once again, on their call, they highlighted that it was the 11th consecutive quarter of growth for Hollister. That typically tends to lean into a younger consumer that seems resilient, seems to be willing to go out and spend if they think they're getting this bang for their buck. But something else that we also heard from running or on holding CEO Martin Hoffman yesterday is that these potential refunds that they could be getting because of that latest SCOTUS ruling, that's not taken into consideration within their guidance. Abercrombie echoed that similarly. They still assume the 15% global tariffs announced by the administration that are effective beginning February 24th.
All right, thank you, Brooke. Well, CrowdStrike shares, they're higher after reporting better than expected fourth quarter earnings and issuing an upbeat first quarter forecast. The CEO saying the AI revolution is creating a massive growth opportunity. And Julie Hyman spoke to RBC Capital's Matt Hedberg about these results in Market Catalyst this morning.
Honestly, we thought it was a really strong print. It was a beat and raise really across all metrics. I think part of it is when we looked at the broader tech segment, cybersecurity stocks were seen as more defensive relative to other elements of the software landscape. And so a name like this had been more resilient than other elements or other aspects of the software market. And so I don't necessarily see it directly as a result of the results that they put up, but more so just kind of broader software sentiment these days.
Yeah, which is lousy, to put it mildly. I mean, how do you think CrowdStrike is addressing that? Is it addressing that directly, some of the concerns around that, and has it made a convincing argument about its moat?
Yeah, absolutely. And by the way, we think cybersecurity, especially in the AI and agentic era, will be paramount. When you think about the potential risks with agents and with data, traversing the network, having a next-gen cybersecurity fabric is paramount. We think CrowdStrike is well positioned to deliver those capabilities. Last night, we had a chance to catch up with the CEO, and he went on, and I think he outlined a pretty compelling argument for why CrowdStrike is well positioned to protect companies from these next-gen threats. And we think that when we think about some of the durable moats that a company like this has, including really unique data sets, that's really hard for frontier models to replicate. We think CrowdStrike is ultimately a consolidator from a cybersecurity perspective.
So Matt, what do you think, whether it's with this cybersecurity stock or other cybersecurity stocks, what do you think sort of convinces the market of what you're seeing? What do you think? What proof point is going to do it?
I think that's the key, that's the critical question. On one hand, I would say growth acceleration for all software companies is paramount in this environment. Now, CrowdStrike delivered that. They accelerated now for the third straight quarter from a net new ARR perspective. So clearly that alone wasn't good enough. I think ultimately the company talking about how AI is actually tangibly driving upside to estimates. This is something that I would say for all software companies, not just CrowdStrike. But showing that AI is truly a tailwind to growth, I think will be important for not only CrowdStrike, but the whole software landscape. And I think as we progress through calendar 26 and into calendar 27, I think it's going to be more evident with CrowdStrike that these increased AI threats are driving increased module adoption, and that ultimately we think this stock is well positioned to benefit from that.
Matt, I want to ask you also about Iran and the potential for cyber threats there, because the CEO talked on the call about this, talked about AI weaponizing adversaries to attack with increased speed, sophistication, and precision. Do you feel like, a company like CrowdStrike is well poised to address those threats? How quickly could they come? And what is that going to mean for that company and for the industry?
For sure, yeah. Whenever we see global conflict, the chance of broad-scale global cyber threats certainly increases, and we do think in this time of uncertainty with Iran that you mentioned, having the protective blanket effectively of a CrowdStrike platform, we think is paramount for a lot of organizations to think through protecting against these zero-day threats. Listen, there's a chance for malware that we've never seen before, and having the data architecture that CrowdStrike has with the Falcon platform, we think is really important in understanding the correlation of data points and seeing some of these threats before they actually emerge. We think a good defense is paramount in times like this, and so not every cybersecurity platform is built this way, and we think ultimately having the ability to correlate data across multiple different devices is really unique from a cybersecurity perspective.
Matt, I know we're talking about weighty issues here, and this feels like a very pandemic era comment. Love the sneaker collection behind you. Obviously, you're pretty into it.
Yeah, I say covering software stocks, I'm 80% therapist, 20% analyst these days, and so trying to preoccupy myself with other endeavors is certainly, I think, important in this era.
Coming up, we head over to the New York Stock Exchange to talk value investing with our very own Jared Blickery. Stay tuned. Sending over to the New York Stock Exchange, where Yahoo Finance's Jared Blickery is standing by with Lee Munson, Portfolio Wealth Advisors President and CIO. Jared.
Thank you, Lee. We got to talk about this week's headlines and what happened and also what didn't happen. What were you expecting and how do you see this playing out in the short term?
Well, 20, 30 years ago, we would have expected to see the VIX over 30, volatility shoot up, maybe 6, 7, 8, 9% by this time, and it's a big nothing burger. I mean, right now, we can't even get 4 to 5% below the all-time highs on the S&P 500, and we're going to war with Iran. So I think that that's the most shocking thing. And there's some reasons why I think that, but it is very interesting coming into Monday and not seeing a bloodbath. And every morning, we open lower, and then we rise into the close, even though we have a lot of downside volume.
So if this drags out, at what point, what levels in the major markets, whether it be crude, the US dollar, S&P, Qs, whatever, at what point do you think, okay, that's my signal that this is going to be a longer term issue for the markets?
Okay, if we have supply issues and we can't get oil out of the Gulf over here, and we start seeing oil above 90, close to 100, then all of a sudden I think that we might have a supply shock. Then we're going to see inflationary pressures. Now, I think those can be relieved with some Fed cuts. I think that, AI productivity, that's deflationary. But if you really want to move the needle, I've got to see the price of oil go up. I've got to see volatility expand, and we've got to see some liquidation in markets, not just people buying growth, people buying value, people buy the Mag 7 or what we call the Mag 7 and the 493. And that's all we've seen this week, just back and forth like a tennis match.
All right, you said the magic word value, it's your bread and butter. So at what point does tech become value? I love your notes. You're saying make tech value again.
Yes.
So how does that happen? When does it happen?
I think it's going to take all year. A lot of people think that you only can get a valuation reset by having a big correction, right? But remember, tech earnings are still there. They're accelerating. I mean, we're almost at a 25 to 30% earnings per share growth on the NASDAQ this year. I mean, who could imagine that? I mean, the S&P has a 16% 12-month earnings growth this year. So in my opinion, if we could just have the NASDAQ be flat until Christmas, then the valuations will be around what they would be back in 2015 when nobody was suggesting that the NASDAQ was overvalued.
So you're talking kind of a correction in time. Let's talk about the SaaSpocalypse. It kind of ties into what you were just talking about, but any names in particular you're watching, bellwethers, or just some color commentary you'd like to share here?
Well, first of all, software multiples can go lower, and I think it's dead money right now. From a chart perspective.
For how long?
I think it's going to be another 6 months. And so I want to see a major washout in software, and I want to see companies and the general sentiment not so concerned that Citrini Research put out some sci-fi piece last week and everybody has a reaction. But the bottom line is, when you look at it, we've all dated Adobe here and there, and
Yes.
Yes, and it's a train wreck, right? There's nothing wrong with the company, but there is this fear at Adobe that they're not going to be able to adjust to AI and these software companies are going to go away. I think that's completely nonsense, but until we see real proof that these companies are embracing AI and can monetize, they can get people to pay more per month for their existing products, seats, because here's the thing, if you don't get them to pay more, there's no seat growth now. We're going to have more productivity, but we're not going to have more net hires. In fact, no net hires is the positive outcome. Right now, if you're a CEO, all you have to do to reduce 10% of workforce or more is just say, AI made me cut, right? And every time you cut, then that means less seats to Salesforce, less seats to Microsoft Office, less seats to Adobe, and that's what the problem is. And so the only hope for these software companies to keep their multiple, which I do not think they will, is that they start charging double for the productivity dream that they keep talking about. And I think we're 6 months away.
Interesting. Well, it also brings up the Federal Reserve, because the Federal Reserve has been talking about productivity, and that may or may not be an excuse to do certain things. What do you think the Fed does this year, bottom line?
Well, put it this way. They're going to have to start cutting. We're expecting them, up until the Iran situation, to cut slowly, that it's going to take all year to get 2 or 3 cuts. But I think once May happens and we get the new guy in, if we still see oil in the 80s, or we see some supply shocks, I think you're going to see rates go down. I think that growth is going to come into question.
So you don't think they'll be scared by the inflationary aspect of oil 80, 90, maybe even 100?
Well, I think that we'll see. But remember, this isn't Gulf War I, back in the 90s. We have energy independence. We are net exporters of oil, not net importers. So ever since 2012, we learned how to drill horizontally. We have what's called the shale revolution. And so we're just in a different place. And you can see it. I mean, why isn't oil at 100 right now? Because we're drill, baby, drill. And so I just think it really takes that shine off the inflation. It's a clamp down on inflation because of how much we're drilling. And also, this current administration is into loosening regulations and having lower prices for energy. And believe me, if you think it's a coincidence that we change regimes in Venezuela to start letting that oil flow up here, and then all of a sudden we're hitting a place that's pumping out millions of barrels in oil, that's not a coincidence. That's a strategy.
All right, I want to get to gold, keep it with commodities here. You mentioned a double top in your notes. It's up multiple hundreds of percent. Well, so is silver over the last 3 years. So how do you see this playing out in some of these shiny commodities?
I think it's a buy on the rumor and sell on the news. I stopped trading gold so many years ago, wish I hadn't. I think all the gold bugs, I'm glad they're having their day in the sun. They finally last summer got gold adjusted for inflation above its high water mark from the early 1980s. So for my dollar, I want cash flow, I want interest payments, I want something underneath that. But gold, to me, this is more a nihilism play. It's a bet on Armageddon, and it's a bet that I don't want to play right now. I'd rather back up the truck later this year on the NASDAQ 100, maybe look at select software. Hey, we might go date Adobe again. You never know what could happen.
We got time for one more, Lee. I'll give you the floor. What's on your mind here?
I think that investors are underestimating how long this war is going to be and how deep it could get. And I think that now is not the time to think that you're going to buy some good deals. I think you want to wait for a widespread liquidation. I think you want to see volatility above 30. And out that, I still think we're going to have a great year for value. But by Christmas, bring me back and ask me, did you trim your value positions to go buy tech? Because I bet you I'll say yes.
I'm going to ask you if you trimmed your 30-year bonds. All right, we got to go, but thank you, Lee, and back to you, Josh.
Thank you, Jared. We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Stocks close higher. Our very own Jared Blickery is live from the New York Stock Exchange with the very latest. Jared.
Thank you, Josh. Well, guess what? Mag 7 is back. Tech is leading. It feels like 2023 all over again, but it's kind of not. I'll tell you what, the reaction this week to everything that's gone on, all the headlines, has been very on again, off again. One day you'll see leadership emerge like Monday in energy and defense stocks. Then the next day, most of them are down. So it's very touch and go here. But for me, I've been watching a few different markets, three in particular: crude oil, the US dollar index, and the S&P 500. None of them have really crossed what I would consider critical thresholds. And so you take a look at today's tape. I'm looking at the VIX volatility index, closing right now about 21. So we weren't even able to punch above 30 earlier this week. And I can't help but remember my conversation with Lee Munson of Portfolio Wealth Advisors just a few minutes ago, saying this could easily drag out another few months. And then you plug in a new Fed chair, we could get some rate cuts, et cetera. But the big picture is, I think there's still a lot of uncertainty priced into the market, but certainly not panic levels just yet. So we're still kind of operating in the playbook that we've seen since the beginning of this year, if not extending back a few months into the previous year, which is it's all about rotation. I don't know that we're going to see the Mag 7 leading again tomorrow. It'd be great if we could and get back to record highs every day, but that playbook seems to be out the window. So until software can start catching a bid on a consistent basis, until we see the Mag 7 really driving the S&P 500 and the NASDAQ 100 higher again, I think we're going to see more of this on again, off again, where you just have to play the rotation trade. So sit pat if you're a long-term investor. Watch some of those key levels, 6,800 in the S&P 500. Crude oil goes north of 80, or the US dollar index north of 100, then we've got a different situation. In the meantime, we're just standing tight here.
All right, thank you, Jared. Well, as geopolitical tensions spur volatility in U.S. stocks, we're looking at what the whipsaw action means for investors. Matthew Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Matt, it's good to see you. So, stocks, as Jared was mentioning, they've turned more volatile since these strikes on Iran began. Matt, I'm curious, long-term investor that you are, do you look at this, Matt, and say, okay, it is short-term noise for investors, or no, there could be material impact on the economic outlook?
Well, good afternoon. Thanks for having me back. I think for investors, the key question you have to find the answer to kind of find some conviction in whether this is shorter term or longer term is, what does this mean for the macroeconomic situation? Does this lead to higher levels of inflation, higher levels of interest rates over a longer term horizon, versus what we've seen in the past for a lot of geopolitical events, it being a few weeks here and there, and before you know it, things are kind of back to normal. If it's the case where it's kind of more back to normal, we don't necessarily think that this is going to be something all that impactful for the longer term investor. You go through history and you look at geopolitical events, and really the demarcation line between does this impact longer-term fundamentals or not, or longer-term returns, is whether or not it causes some sort of disruption in the economy. We're only a week into this, half a week or so. It's just too early to tell. However, I would say that just the overall energy markets are absorbing this fairly well. There's certainly been volatility, but in terms of where we're at from an oil price perspective, it's not necessarily something that to me gives me a whole lot of concern at this time. So
I guess, Matt, what would be the signs and signals on your sort of daily radar? What are you watching for when deciding, okay, whether this could have real material economic impact? Would it be, Matt, oil prices? Is it inflation expectations, credit spreads? I'm just curious what's on your radar, what you get up and watch.
Yeah, it'd be the final two that you mentioned there: inflation expectations, longer run in nature, and then credit spreads. And so far, what you've seen in terms of inflation expectations on the 1 year basis, they've ticked up about 30 basis points or so. And remember, this didn't completely catch the market by surprise in terms of, this activity over in the Middle East. It's been rising in the probability markets over the last month or so. So you've seen inflation expectations on the front end of the curve tick up by about 30 basis points or so. That's not a huge move, but it is part of a trend that you should watch pretty closely. Secondly, is the credit markets. Just to put it into context, what it means for the stock market. The stock market is pretty tightly correlated with the inverse of credit spreads. So the higher spreads move, the more compressed multiples become within the stock market. And so if you start to get a credit market that gets out of whack and those spreads gap out 100 basis points, 200 basis points or more, that means you're starting to risk a higher level of probability of a correction in the stock market. We're not there yet. They've moved out about 30 basis points or so off some pretty tight levels. So those two areas I think are probably the most impactful for an equity investor at this point.
There was, Matt, a new Goldman note. I don't know if you saw this, sort of making the rounds. This got some attention. They're telling their clients equities, they say, could be vulnerable to a correction after such a strong run. They talk about valuations. They say valuations across global markets are above their long-term averages. That's not just in the U.S., they say. Do you agree with that, Matt? And I guess what needs to kind of go right, Matt, for stocks to sort of justify their prices here?
Well, if you look through history over the last 60 years or so, what drives corrections in the market? And I think that'll get to probably some of the emphasis points on that Goldman piece, which I didn't have the opportunity yet to take a look at. There's two major things. One, it's a huge surge up in the unemployment rate or a huge surge up in interest rates, both of which, and that's where the real downside risk to equities comes from. So kind of put today's events into kind of that lens, and what you see is the potential for longer term rates to move higher if inflation expectations move higher, or the unemployment rate to move higher if this impacts consumer spending. So it's just too early to tell in those two areas. But certainly, if part of the argument from that Goldman piece was that valuations were high, which means there's just not a whole lot of compensation for risk. I would agree with that. You're in top decile valuations for equities. That doesn't necessarily mean that they're going to correct because you need a catalyst for that to occur. But it doesn't give you a whole lot of cushion if credit spreads do gap out higher, like we've seen a little bit so far this week.
Goldman also highlighted market leadership, Matt. I'll read this to you. They highlighted rotation, really, and they talked about the rotation away from tech stocks and towards, they called out value, physical assets, CapEx heavy industries. Do you see that rotation, Matt? Is that short term or no? You think something more structural has changed?
Well, I think that you kind of look through history, and it's pretty abnormal to have as narrow markets that we've had over the last 3 years. Just take the S&P 500. What percentage of the members of the S&P 500 have outperformed the overall index the last 3 years? It's been between 20 and 30% the last 3 years. That's pretty unusual. That's well below the average. And there's probably a good reason for it, and that's earnings growth. It's been so centered in mega cap tech. What's changed in the operating environment, though, is that earnings growth is starting to broaden out across the economy. In fact, one of the fastest areas of earnings growth since mid-May of 2025 has been small caps. And you've seen the price and performance of small caps respond to that inflection in earnings growth. And it comes with a different price tag than the S&P 500. The S&P 500 trading 21 times expected earnings, which are going to expected to continue to grow at a nice, healthy clip. But you're seeing pretty similar levels of earnings growth coming from small cap now, if not better earnings growth coming from small caps. And that's trading at a fraction of that multiple, around 16 times or so forward. And so that is fuel for rotation under the surface. It's not necessarily bearish for tech, I would make that argument, but it does mean that there's different parts of the market that can provide returns to an investor.
Finally, Matt, I want to get this one in here. You talk about this AI boom as everybody's looking for winners there, for opportunities. You talk about investing in what you call the constraints around AI. Walk me through that.
Yeah, so the constraints around AI really just comes to kind of we're seeing so much spending in this space, and it only continues to get revised higher. Just from the fourth quarter earnings reports, you saw hyperscalers revise up 2026 estimates another 20% plus. And so with that level of spending, you're really stressing the system around kind of what all goes into making that investment happen. So it could be power, it could be memory. Just to put the memory markets into context, because this is one of those constraint areas, and just since oil is so topical right now, what's happened in memory markets is the equivalent of moving oil from $60 to $350 in the period of 2 quarters. That's how tight that market has gotten. It's pretty profitable to be on the other side of that and be the one selling the memory. So that's the kind of thinking that goes into kind of where we're looking for opportunities around this ongoing buildup. But at the same time, some of the major compute suppliers, whether we're talking about NVIDIA or Broadcom, are going to continue to print some pretty healthy numbers as long as this spending continues.
Matt, as always, so good to have you on the show. Thanks for your time. Airline stocks struggling to recover as concerns grow over potential impacts from the Middle East conflict. Yahoo Finance's Broadcom and Praz Sumerian are joining now to discuss. Welcome both. Praz, I'll start with you. Let's just start there. So if I'm an investor in an airline, right, I'm looking at this, I'm kind of wondering what all this means for their profits. Like if you continue to see flights get rerouted and then fuel prices stay elevated, how should I think through that?
I think it's probably 2 parts, right? So domestically, yeah, fuel prices are a big problem. We're seeing in California, jet prices are climbing up almost double what they were before. So even domestic carriers are going to feel pinched there pretty severely in their margins. As you know, those gas prices are impact everything very severely. And then talking about international flights, I didn't realize this, but apparently the Gulf area, Dubai, places like that, 12% of all global traffic goes through the Middle East, right? Originations is a big hub there. That's all kind of basically offline now. So you have pretty wide disruption across the global players, even the Deltas and Americans that fly a lot internationally, not to mention, of course, the national carriers of those Middle Eastern countries. So yeah, a lot of disruption there and potentially a lot of losses there when you talk about airline investors. Look, investing in airlines is not a thing you take lightly, right? You really invest in airlines, you really like to roll the dice. So it's just adding more sort of uncertainty to that already strained sector that just really kind of is the most, I would say, tethered to the consumer, right? The most discretionary purchases are airlines.
Yeah, and also, Josh, we're now hearing from Secretary Marco Rubio saying that American citizens in the UAE, Qatar, Saudi Arabia, and Israel, they're recommending that they do leave. And I've been following this WhatsApp chat, actually, this channel that the government had put out. And every so often, we're getting these notifications about assistance that is coming forward, how exactly they can be assisted to escort or move out of these countries. And this could definitely damper sort of the fear among Americans to travel, to get out there, to spend their money, and to ultimately go elsewhere beyond the U.S.
Switching gears, Broadcom, sticking with airlines, but a very different kind of story. United can now ban passengers who don't wear headphones.
I did see that.
All right, the airline can refuse transport to passengers who play media without headphones. This is per USA Today, and they're reporting. Now, you can request free earbuds. You're not going to be sitting in silence. But if you're going to play something on the iPhone, not everyone wants to hear it. I was actually surprised this was not already a rule.
I mean, does it have to be an actual rule? I mean, isn't it kind of just like a...
Yes, it really does.
You it's really not just courteous.
Let me tell you, Broadcom, if you're on the New Jersey Transit every day, this has to be a rule. Yeah.
Okay, but they're not offering free headphones on the New Jersey Transit every day.
No, there's no free earbuds.
So you're just putting up with it.
Yeah, and even if they did hand those out, I'm not sure anybody would take them.
But this is sort of a revised contract of carriage, they're calling it. They updated it quietly over the weekend on Friday. And so, warning.
Good for you, United.
If you're getting on a flight, you probably should bring some AirPods.
Yeah.
That's the bottom line there.
I mean, look, this has been a problem for anyone who travels at all, just a little bit.
Do you take any kind of public transportation? This is an issue. Yeah, that's the truth.
Subway, etc. So it's kind of surprising, Josh, that United was the first to do this, right?
Yeah.
It kind of, it's not the same thing, but we talked about last week. A little funny thing was in Tampa Airport where they said, no Crocs, no pajamas, right?
Yes.
They're setting rules for just genuine, or just general
civility. Now, is that an actual rule?
I mean, I don't know how you enforce that, but they just basically said we'd have guidance that says if you don't want these things.
Well, I don't know when it really...
Secretary Duffy said the same thing, right?
It is a fair point. At what point we sort of decided it was appropriate, frankly, for adults to show up in their pajamas to the airport?
I feel like the majority of people do.
The flip side I saw is that people were like, you know what? airlines, if you make our lives better, if you make it less miserable, we'll dress better. So it's like a whole give and take.
Like, you know what you're getting into. You want to be like comfy.
There are other rules, by the way. Here's United. You can also, you could get banned, Praz, apparently. You could get the boot for lewd or obscene clothing. So you're in trouble.
Why are you looking at me for that? Why am I?
Yeah.
We're all wearing button-ups and dresses now when we travel.
Well, we have seen that before. Women, some men or women getting kicked off a flight for wearing revealing clothing. So I guess there's just a standards and decency policy.
What really leads back to the pajama discussion, because I can't imagine what you would have to wear to be considered so obscene or inappropriate that you have to get the boot. Well, we can look into that for the next discussion. One final airline theme, Praz, for you. This is from the Journal. All right, they have a new piece on tiny new airport lounges. These are kind of new outposts, apparently, from they get called American Express, American Airlines. Kind of an antidote, they're calling it, to packed airport clubs, they say. For example, here's your example. You got a new lounge at the Harry Reid International Airport. All right. Serves lobster rolls, avocado toast. There's a bartender making mixed drinks for you and cocktails.
Sounds really nice.
What do you think?
I mean, what we've seen is that the lounges have become sort of another part of extension of the airport. Everyone has lounge access, right? You have an Amex Platinum, you go into Delta Lounge. It's been making it kind of not a non-premium experience, right? So they got to try harder and harder to make newer, more exclusive spots in the airport. I mean, you talk about the American Express, I think this American Express Lounge with 20 people seats there. They have a Centurion Black Lounge in New York City, in the city, not in the airport, where you can only go with the Amex Black card, right? Yeah. So it's all about this, how do we make these experiences more special? How much money can we charge for these things? Right. It's great, big margin things. I mean, look, Delta has the Delta One lounge at JFK now. It's only if you're flying first class international, Delta One. No one else can go there. And they have a spa, multiple restaurants. I think there might even be a speakeasy in the lounge. And stuff like that. Like, people want these things. They crave.
And that's a new build, isn't it? Or the one at Newark might be new as well.
The Delta one is new in JFK, but probably in Newark too.
Yeah, I mean, I'll admit, never been in one of these lounges. Don't have a platinum card. Not paying the $1,000 annual fee.
Well, now you get lobster rolls and avocado toast, Brooke DePalma.
But I will say, it's interesting. I was reading up, and you can only go into it 90 minutes before your flight even takes off. So you better arrive pretty close to the time you get through security.
What's happening now is that the lounges are so packed that the actual terminal is a nice, comfortable place to be. You can sit back. You got seats now.
Yeah, because these are getting packed out. Yeah. More room for people like me.
No matter how nice you make it, though, you're still at the airport. Yeah, is the ultimate problem. But I appreciate the effort. A+ for effort. Praz, Brooke, thank you. Appreciate it both. Coming up, we'll bring you Broadcom earnings. That's next on Market Domination Overtime. Broadcom's first quarter earnings, they are just now crossing the wire. Q1 adjusted EPS 205. The estimate was 203. In terms of the top line, Q1 net revenue 19.31 billion. Consensus was closer to 19.26 billion. Turning more importantly to the forecast here, Q2 revenue about 22 billion is what Broadcom is calling for. The estimate was closer to about 20.53 billion. You do have some capital return news as well. Broadcom approving a new $10 billion share buyback program. Just looking through the release here, some comments from CEO Hock Tan. Talks about Broadcom achieving record first quarter revenue on continued strength in AI semiconductor solutions. He says Q1 AI revenue, 8.4 billion, he says, grew 106% year over year. He says that was above the forecast. Our AI revenue growth is accelerating, Hock Tan says, and that we expect AI semiconductor revenue to be 10.7 billion in Q2. You look at the reaction here in the after hours. Initially, we're pretty much flat here in the after hours, so investors at least initially look underwhelmed. Remember, heading into this print, this stock was down about 20% from that December record, and really part of kind of a broader trend we've seen. Investors have been skeptical that all this big tech AI spending is really going to stay at these elevated levels, and therefore names like Broadcom, they've been concerned about whether they can keep really benefiting here. The street is very bullish on Broadcom. 95% of analysts still do have a buy on Hock Tan's company. We know some key questions you would expect on the call. Broadcom's relationship with Google, that's going to come up. Remember, Broadcom builds chips for Google. You would expect questions there, whether maybe other big tech customers could be coming. There will be a focus, as always, on this company's AI backlog, what the margin trajectory looks like, questions there for Hock Tan, and of course, what Hock Tan has to say about his big deals with high-profile names like OpenAI and Anthropic. But at least initially here, stock not doing a whole lot in the after hours. We'll wait to see what Hock Tan says on that conference call. Let's get to some more reaction for Broadcom's first quarter earnings. So joining me now, we've got Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, Broadcom reports. What do you make of the print? What do you make of the response, Ben?
Yeah, I mean, I think the response is more just looking at, the expectations that's been set, right, for this company, especially in terms of where everybody hopes the AI revenue grows, which will really be, a big part of their flywheel for obviously networking. We still see a lot of growth in networking, obviously as back end, that's the fabric for all of these racks. And then the custom, semiconductor stuff, I think remains one of the biggest bright spots for them. While we'll continue to see that grow. So I think we'll have to see on the call. I mean, I expect still a whole host of confidence from Hock Tan on both the outlook, what they see for this year. He'll probably try to deal with some of the concerns that you mentioned, which I think is a sensitivity of the whole industry about can we keep this CapEx going and can that really tie to revenue. So I do think there's some of the concerns too around Broadcom being just, again, the concern competing with NVIDIA when it comes to their customers who are building custom ASICs in a supply constrained and a power constrained environment about what risk of ratio those are. So I think more will be clear on the call, but like I said, I think expectations remain high for this company. I'm not surprised it's flat. There was a lot priced into their growth. So it seems like they met, to a degree, what people were expecting.
Ben, it is interesting, though, because you mentioned NVIDIA. So NVIDIA reported, right? That was a solid report and a solid guide, and investors sold it. And now you have this, lukewarm reaction here in the after hours. We're basically flat. That point, Ben, you brought up, this sort of broader industry-wide concern where, investors feel like all this big tech AI spending, maybe some skepticism, Ben, that can really sustain that, and then that causes them some worry about the downstream beneficiaries like an NVIDIA, like a Broadcom. What is your answer to that, Ben?
Yeah, I mean, I think there's two things, right? One, we're trying to operate on what management's telling us. So if you just listen to what the hyperscalers are saying when it comes to their overall position on what they're going to do with return on invested capital, they're bullish, right? They're not putting out specific numbers. Very few people are really pointing or quantifying AI revenues, but I think we're going to want to see that go. So it's more than, hey, you guys all sound like you have a framework that justifies your return on invested capital, but that we will actually see their AI revenues inflect. So while you hear the commentary, the proof's going to be in the pudding, to use the Jerry Maguire line, right? People want them to show them the money. And I think once that happens, these concerns will be alleviated because they will believe that dollars map to compute and infrastructure spend. But we don't have that. That's that tension. We just don't have clarity when that's going to happen at scale.
Ben, I only have a couple minutes left, but I got to ask you this. We got to talk Apple briefly. The event today, the headline, the MacBook Neo. This is this lower cost notebook, starts at $599. What do you make of that product? Who's it for, Ben? And what kind of traction you think Apple gets here?
Yeah, so really aggressive price point with a current market skew. I think anybody who's tracked the space has known a couple of things, right? That Apple's largely saturated the consumer market when it comes to Macs. So there's growth, but not double-digit growth on that front end. And while they do have what has been sort of an N-2 skew at certain retailers where MacBook Air might be $699, I think the market has been itching to get into the Mac ecosystem with a current leading-edge product. And so I think this is their attempt to do that. We think students, this fits right for, obviously, high school, junior high. We could see some areas where they play for Chromebooks as well. But very aggressive price point. Again, with the student discount, it's $499. We think this will do very well and kind of help people enter the Mac ecosystem at a price point that I think they've been waiting for some time.
Ben, as always, so good to have you on the show. Thank you, sir.
Good to see you, Josh.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of that break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. Prospects of Tesla's robo-taxi keeping Bank of America in its corner. Firm laying out a bullish outlook on the company's autonomous efforts. And Yahoo Finance's Pras Subramanian joins now with more Pras. All right, so Bank of America, they reinstate coverage of Tesla with a buy rating. All right, they're in. The part on robo-taxis I thought was interesting. Just walk us through, because you wrote about this, how sort of the analyst is kind of framing that opportunity for Musk and how he sort of compares and contrasts Tesla and Waymo in that fight.
So, nothing new here, right? So the analysts here, Alexander Perry, talking about how Tesla has an advantage from both a bill of materials point of view. They build these cars. Their robotaxis are cheaper because they're camera based. They don't require all these sensor suites that a Waymo might require. Essentially saying that a Waymo costs $150,000 to make, whereas a Tesla could be $40,000 for a Model Y, right? So huge benefit there. And then also the fact that that's from autonomous robotaxi, but also just sort of FSD kind of. But from a ride-hailing point of view, comparing to Uber and Lyft, there's no human driver, and their calculations show that the human driver costs about half. For a $20 ride, average ride, about $9.60 is the driver's compensation. So if Tesla has robotaxis, they're at half that, right? So that's sort of the bet is cheaper to build, and then also from the ride-hailing point of view, you have the actual no drivers. That's good for comparing against ride-hailing companies. So this guy says that 52% of the Tesla's enterprise value that he's calculated is just robotaxis alone. So there you go, right?
Polymarket all over this. Here's what they got ready. They say, Polymarket showing here, let me get this right, 22% expect Tesla to launch robotaxis in California by this summer, by June 30th. What does the likelihood of that look like, in your opinion?
I think that's too low, to be honest with you. I think it is too low, because right now they're just basically operating a ride-hailing service in California, right? They have the cars there that are being picked up by the Tesla app, and there's a driver in there, right? They have not even applied for the permits that Waymo has to operate a autonomous ride-hailing service, and that takes months. You file it, doesn't mean it happens right away. It takes months, and you got to prove that your vehicles are safe. You got to do a number of different things that the California Utilities, which runs that program, has to see. So if they're saying by June 30th, 22% chance, I mean, maybe that's okay. Obviously the thing with Polymarket is and Kalshi is that it's all basically people with inside info, just basically making it aware. But I just think that it's going to be hard by mid-year.
What about the full self-driving as a software business? The analysts dug into that as well.
Yeah, I mean. If you talk about, like we talk about the Model Y with just the sensor suite, a camera suite, it's easier to make these cars. It's cheaper to make, more scalable. That cyber cab that you showed in that Polymarket thing is the cheap, bespoke. Basically, it's purpose built just for robotaxi. So they're able to make these cars cheaper. But with regards to FSD, look, it's early stages here. FSD adoption, the analyst sees that increasing. It's over 10% right now. Musk needs to see that number go up to get more money in his compensation plan. So there's going to be some motivation there. But also, if you look at it as some of the parts analysis, 19% of that is just FSD. 50% or so was the robotaxi. So 70%. Just thereabouts is robotaxis and full self-driving are what this analyst says are the full enterprise value of Tesla.
Does the analyst big picture, does this note sort of dovetail with how Musk talks about the future of Tesla, which is AI, autonomy, robots?
Yeah, I think so. I mean, again, that some of the parts analysis, 19% of that is just the automotive business. But guess what? The automotive business makes 90% of the profits, right? So it's sort of the future. What does Tesla look like 2 years, 3 years, 4 years, 5 years down the line? It's going to be robotics. It's going to be cyber cabs. It's going to be robotaxis. There's a lot there that's very interesting and very future forward looking. The question is, can Musk deliver, right? He has shown that he can. It just takes sometimes longer than what he has said before.
Finally, your thoughts here in your world. This story from Reuters about GM. Reuters saying GM is putting more focus on used cars through its Car Bravo platform. What is the story there?
I'll be honest with you. I didn't know what Car Bravo was,
Yeah,
but I guess it's like a platform you can buy used cars on, and I guess GM was using it to sell some of their certified pre-owned vehicles that were newer used cars that had a warranty that you could get almost like a warranty for a new car. Hey, great, cheaper car, manufacturer backing, great. But what's happening now is that per Reuters is that GM's asking its dealers to put more cars on there, almost all of their cars that come off lease and GM cars, and then they want to try to warranty them and have this service. But also non-GM cars and get this cars that are 10 years old or even more that would qualify for warranty. So,
did you look at this? I guess, Pross, okay, this is a broader trend of this is automakers saying, hey, affordability is front and center for a lot of Americans.
Yeah, definitely. I mean, look, the piece talks about how for GM itself, like GM we get new buyers from people coming into trading in old used cars. So they've seen that certified pre-owned used cars are a way to, people buy a car there and they come back and they might buy a new car. So great. It's addressing affordability, but also it gives us new funnel for new cars, right? But also, they mentioned Carvana in this piece,
I was
right?
going to ask you, when you read this, I'll just get this last question in there. When you read this, did you say, okay, this is new sort of competitive risk for Carvana?
I don't know, man. Carvana's got a big brand in the United States here, right? A lot of people love that service. You can buy anything you want, any part of the country. They deliver it to you. I feel like that's just its own offering that CarBravo might be able to eat into a little bit. But if you wanted a certified pre-owned car, you're not going to Carvana. You're going to go to the dealer anyway, right? Or maybe in this case, CarBravo. Carvana is just, hey, you get a week warranty, I think. Here's the car, take it or leave it, cheap price. And I think that's just two different business models.
All right, Pras, thank you, buddy. Appreciate it. And you can check out more from Yahoo Finance's Prediction Markets Hub, powered by Polymarket, by scanning the QR code on your screen. Stick around, much more as for trends still to come. Qualcomm announcing a partnership with dozens of companies, including Google, Microsoft, and Amazon, to help bring 6G to market by 2029. Julie Hyman spoke to the company's CFO and market catalyst this morning about that news.
We did this about 10 years ago, where we introduced 5G at the Mobile World Congress in concert with a bunch of partners across the industry. And we're doing the same thing again here with over 60 partners supporting us in introducing the concept of 6G. And as you'll recall, we started with 3G doing data on phones. Then we put a smartphone, a PC in your pocket with 4G. With 5G, we improved the data rates to be able to do social video and things like that. But with 6G, there's a massive change coming. I think this is the first time that you're going to have an AI native network where connectivity and AI come together to significantly improve the performance and the services that an operator can offer with 6G. So very excited about what it means. We're just at the beginning. We're going to see pre-commercial devices in 2028 with the Summer Olympics. And then in 2029, we'll have commercial devices available as well. So very excited.
So here we are in 2026, and you guys are talking a lot about this. Talk to me about the R&D investment and ramp for that versus when you guys expect that revenue payoff to begin. And I assume that's more of the 2029 kind of timeline.
Yeah. I mean, this stuff takes a long time, right? We invest typically 10 years in advance of something showing up in a network, in a device at scale. And we invest in very early research. We build consensus in the industry. We publish papers. We write patents. And then we do standards building where we get other companies together with us and we decide how we're going to launch networks and devices. And Qualcomm has a very central role in bringing the ecosystem together. And it's been the leadership that we've shown over the last several decades, now coming on again with 6G.
And Akash, a lot of this also speaks to the idea of edge AI, right? And you guys had some other announcements more specifically on that front at MWC too. Edge AI being like on-device AI versus cloud AI. And should people be thinking about edge AI as a complement to cloud or a replacement for? Is it an instead of or an addition to?
Yeah. If you look at, Julie, how computing has happened over the last several years, you do some computing on the phone and you do the rest of the computing on the cloud. And edge AI is no different. You're going to do some of the AI workloads on the edge and some will happen on the cloud. And it depends on what you're trying to do and where the context and the data is available. If you think about an agentic AI conversation where you want to talk to a device and get some information from it, and glasses are a great example of that. If I'm wearing a smart glass like the Meta Ray-Ban, I could look at something and easily ask the question, what is this? And the model then has to understand the question. It has to understand what the camera is looking at. And so it can feed that data into the model. And then the model will decide if the question can be answered on the edge itself, or does it need to go to the cloud? And it's almost irrelevant to the user. It doesn't matter whether it happened on the edge or the cloud. It's really kind of enabling this unique use case with sensor information that is only available at the edge. And I think when you extend it from consumer use cases like this, then to enterprise use cases, and then to industrial, automotive, robotics use cases, Qualcomm's technology is going to be in each one of those devices. And we just think we're at the very beginning of this kind of the next wave of AI innovation. And it will start at the edge and continue into the cloud.
Akash, do you think that we are on the cusp of sort of a wearables revolution? I feel like we've had so many attempts at getting wearables to really catch on that have not caught on in a mass way. Is that changing now?
Yeah, I think it is changing for sure. So think about a device that is on your person that can see what you can see, that can hear what you can hear, and you can have an agentic AI conversation with it. And so I think glasses is how people understand this concept very easily. But really think about it as something that's broader than glasses. It could be a watch. It could be earbuds with camera. It could be a necklace. But in each case, you have a device that has a camera that can has the same field of view that you have. It can hear the same things that you can. It will learn about your daily happenings as you go through the day, and then really be able to respond to questions later in the day. I mean, one great use case that I've heard about recently is one of our partners in India is implementing a payment use case where you could just look at with your glasses at a QR code and say, pay 100 rupees for this code. And this is, it will read the code, it will go to your e-wallet and make the payment. And it's just something that will come very naturally to the user. And I think as you bring these use cases together, we expect this revolution to take off.
I don't know. In some cases, I want a little more friction between myself and making a big purchase, but I'm sure you can build those things in too. I'm curious about competition in this space. Obviously, Qualcomm is a leader in smartphone chips, so device chips already. As you know, of course, you've got other chip makers that are getting into this. NVIDIA is also in this space. Do you see NVIDIA as a direct competitor in edge computing, or do you think that you sort of operate in different subsegments?
Yeah, I think Qualcomm has very significant advantage when you think about edge computing. One of the big factors in edge devices is that they're battery powered. And because of that, you need a chip that is really high performance at very low power. And that's Qualcomm's DNA. We've done that in phones. We've done that in a variety of other devices. And while we do have competitors, it's an area that we've clearly been the leader in, and we expect to continue to lead there. I think the technology portfolio that we have in Qualcomm is unique and one of a kind, and perfectly suited for edge devices. So I'm very hopeful and optimistic about what we can do going forward.
And then finally, Akash, I wanted to ask you about something that is not an edge computing question so much, but a new partnership you all announced with Siemens.
Yes.
To automate production, to automate manufacturing. Just quickly talk me through that and the significance of that for Qualcomm.
Yeah, I think one of the big areas that has not yet been transformed is industrial. There are so many sensors in an industrial setup, and these sensors collect data. And so far, the data has not been able to be something that you can act on. So when you combine these sensors with the power of AI and combine it with wireless connectivity, it gets transformed. It becomes something completely different and a lot more powerful. AI will be able to take the sensor data, sift through it, make a decision, and then act on it. And then it would use the wireless backhaul to connect into the network and make the action happen. So Siemens, I think, is one of the key partners we have in the area. They understand the potential, they understand the opportunity. And so this is just the beginning of, I think, what we're going to do in industrial. It's very similar to our success in auto over the last few years. I believe that we're going to see a very similar transformation of industrial, and Qualcomm will be at the center of it.
Stick around. Much more Ask for a Trend still to come. New data showing the average 401k balance is climbing. A welcome boost for retirement savers, but more Americans are tapping those accounts early. For more, we're bringing now Yahoo Finance senior columnist Carrie Hannon. Carrie, always great to see you. So let's dig into this. Last year, the average 401k balance rose by 11% to around 146,000. So what do you make of that, Carrie? Does that mean Americans were in relatively better shape now for retirement, Carrie?
Yeah, Josh, this is great news on many levels. And that's a statistic that came out of a recent Fidelity report looking at their plan participants. And those double digits are really quite impressive considering what a volatile year we had last year. But it showed that, retirement savers stayed the course. They didn't freak out during the different dips and all of that throughout the year. And they came out at very high levels of contributions. I mean, they upped their contributions. A lot of them are really close to the 15% that say Fidelity recommends as the right amount, which is your contribution and your employer's into your retirement account. And so that's all great news. And you'll love this. There were more millionaires than ever, a record number of millionaires at the end of the year. So that's kind of encouraging.
Yeah, we like to hear about record millionaires, Carrie. That's good news. You mentioned that volatility last year, Carrie. It's been volatile this year as well. Let's say we stay volatile in 2026. What is the right, I guess, sort of mindset for savers in a volatile market, Carrie? How should you be thinking about these market swings?
Yeah, that's such a top of mind question, Josh. Here's the thing. Many of these people, and the two of us included, we automatically are investing in our employer provided 401k plan. So it's going in when the market's down, it's going in when the market's up. So it kind of evens out over time. And also, it's difficult it's not difficult, but most of us aren't going to quickly, make an adjustment right there. It's consistency over every single month, no matter what. So that's really something to keep in mind, that disciplined investing is key to get through these periods where it's volatile. And in addition, what's interesting in today's retirement saving market is many people, more than 60% have their entire retirement investment in these 401k plans with their employer in target date funds. And so what that means, Josh, is it's not as volatile, right? It's a balance of equities and bonds, and it shifts as you near your retirement age. But when the markets are going a little haywire, it also keeps that ballast for you. So in many ways, it's a self-protection method. Very few people have all their retirement savings in equities.
Sticking with that 401k theme, Carrie, here's another data point that was interesting. More Americans, it looks like, kind of looking into their retirement savings here. Last year, a record 6% of workers, Carrie, in 401k plans administered by Vanguard took a hardship withdrawal. What does that tell us about American workers' finances right now?
Yeah, exactly. You got to say, jeepers, please don't do that. But you have to. That's the thing. When we talk about retirement savers who are doing great, super. But there's another side to that coin, correct? And what happened is this number, that 6%, is triple what it was pre-pandemic of the number of people who took a hardship withdrawal. And what that means is you actually pull money out of your retirement account and you pay that 10% penalty and you pay tax on it. But what happened is in 2018, Congress opened it up to make it easier for people to dip into their retirement savings. Before you had to take a loan first. Now you can just take it out. But the hardship, the number two reasons, Josh, are foreclosure, to stave off foreclosure, and medical costs. Now, these shouldn't be surprising to any of us who are following what's going on in the economy and the rising cost of living. So, yeah, that is troublesome, but you can't blame people when they need it, they need it.
Finally, Carrie, you wrote about another trend, which I want to talk about with you. You wrote a great column about this, which I thought was so interesting, about why more retirees are moving abroad. You say here, 700,000 Americans, Carrie, now receiving Social Security abroad. And you point out that is up more than 20% over the past dozen years. Unpack that for us, Carrie. What is driving that trend?
Yeah, pack those bags. We're moving. It's like it is truly a phenomenon that we're seeing as more retirees are. They're fed up with the cost of living in the U.S. Rising medical costs, after Medicare is sort of daunting for many people. And frankly, the political climate of late has people just a little bit like, I just want a simpler, quieter lifestyle where the cost of living is lower and the healthcare is not as expensive. And so this has been a trend that's been slowly going, but we've really seen an uptick.
Where are these retirees going, Carrie? Where are the top destinations? And do those destinations have certain common themes?
Yeah, when I ask Social Security where they're sending those checks, it shouldn't surprise either of us that Canada and Mexico are two big countries that people go to. They're nearby, right? But there are a lot going to Italy, going to Spain, to Portugal, Ireland. There are a lot of the European countries are pretty easy. Often the language is a bit simpler and those sorts of things. So we're seeing movement to those countries, but there are some other outliers as well. But there are a lot of people have, not a lot, I'd say there are about 3 good lists right now that kind of track all those things: healthcare costs, cost of living, the language barriers, all those things that encourage people to move.
Carrie, as always, great to have you on the show. Thank you.
Thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.